Grupo Aeroportuario Del Pacifico, ticker PAC, Q2 2026 earnings are officially in. And it is a massive profitability beat, despite a pretty glaring miss on core passenger volume.
Yeah, the numbers are wild. Total revenue came in at 11.28 billion pesos, and EBITDA surged to 5.96 billion. But the guidance is what's really turning heads today.
Right. They are basically telling the market to expect flat to negative 3% passenger growth for the rest of 2026. But they are still guiding for a 10 to 12% increase in EBITDA.
Exactly. The stock is already digesting this because it fundamentally challenges how we price infrastructure assets. I mean, they are serving fewer people but making significantly more money.
Which is exactly what we are unpacking today. We're looking at a genuine financial paradox with GAP. They operate 12 major airports across Mexico's Pacific region, so, huge hubs like Guadalajara and Tijuana, and 2 in Jamaica.
And the story buried in this report really does defy basic business logic.
It really does. I mean, think about it like walking to your favorite restaurant, right? Half the tables are empty, there's no line at the door, the kitchen is super quiet. Your first thought is, well, this place is going under.
Yeah, because standard hospitality logic dictates that fewer customers inherently equals less revenue. But then you look at this particular restaurant's books, and they are somehow pulling in record profits.
Right. They're like expanding the kitchen and buying the building next door.
Because they figured out they don't just have to sell food. They started, monetizing the parking lot or charging a premium for a VIP fast lane to the bar. They completely shifted from being just a neighborhood diner to a highly optimized commercial real estate venture.
And that is exactly what we are seeing in this deep dive. GAP is managing to grow profits and finalize these massive acquisitions while dealing with a really noticeable drop in actual foot traffic.
It's a masterclass, really. They are shifting an infrastructure model away from pure volume. And when you look at the Q2 numbers, it's just incredibly counterintuitive.
Okay, so let's get into the specifics, because the headline passenger metrics are rough. Total traffic across their 14 airports dropped by 5.6% year over year.
Which is a huge drop.
Yeah, we are talking about a decrease of almost 891.6 thousand passengers, nearly 1 million fewer people. And predictably, the aeronautical revenues, the fees tied directly to those passengers flying, dropped by 3.2%.
Right, down to about 5.57 billion pesos. And for a traditional airport operator, losing 1 million customers in one quarter, that would trigger an absolute panic on the earnings call.
Passengers are supposed to be the lifeblood, right?
Yeah.
But despite that drop, total revenues actually went up 3.7%.
Yeah.
And their EBITDA, their cash profit from operations, went up 8.4%. On top of that, comprehensive income rose 9.6% to 2.45 billion pesos.
Which is huge. And just to clarify that comprehensive income figure, for anyone who doesn't spend their weekends reading GAAP accounting statements, it's essentially their bottom line net income plus any unrealized gains or losses.
So like currency adjustments.
Exactly. Currency fluctuations or investments that changed in value but haven't been cashed out yet. So seeing that jump almost 10%, it's a very strong signal that their total corporate wealth is growing, even with the shrinking passenger count.
Which immediately brings up the obvious question. Are they just price gouging a smaller pool of travelers? Like, are they charging $50 for a bottle of water and hoping nobody notices?
I mean, it's tempting to think that, but what's fascinating here is that the change is entirely structural. It's all about their non-aeronautical revenues.
Right, the commercial side.
Exactly. Well, the flight-related income dropped. Their non-aeronautical revenues surged by a massive 23.9%. They hit 3.02 billion pesos. GAP is actively shifting its identity from a transit hub, where you just passively wait for a flight, to an active commercial ecosystem.
And they are doing it by ruthlessly cutting out the middlemen. The report shows that revenues from businesses operated directly by GAP jumped 17%.
Yeah, they aren't just renting out space to third-party vendors for a flat lease anymore. They are taking direct control.
It's wild when you look at the breakdown. Duty-free revenues from third parties actually fell by 18%. Traditional retail fell by 3.6%.
But because GAP is directly running the high-margin stuff, VIP lounges, specialized parking, their own convenience operations, they capture exponentially more value per individual passenger.
They are essentially squeezing way more juice out of a significantly smaller orange.
That is the perfect way to put it.
And that surge in direct operational power leads us to the biggest strategic move of the quarter, the mega merger.
Oh, yeah. This is a move that completely altered their balance sheet and really cemented this whole transition toward becoming a logistical monopoly.
On May 1st, 2026, GAP finalized a business combination to take 100% ownership of the Cross-Border Express, or CBX. Now, for you listening who might not know the Southern California border, CBX is not an airport.
Not at all.
It is a highly specialized pedestrian bridge connecting San Diego directly into the Tijuana International Airport.
Right. It's this 390-foot enclosed walkway. It acts as a literal fast pass across an international border. You park in San Diego, pay a toll, walk across a bridge over the physical U.S.-Mexico border fence, and clear Mexican customs right inside the Tijuana terminal.
Completely bypassing the San Isidro land crossing, which, I mean, if you've ever done it in a car, can take 3 or 4 hours on a bad day.
Oh, easily. It's a nightmare. So previously, GAP only owned a portion of this bridge, but they finalized an equity purchase agreement to buy the remaining 25% and fully merge it.
And they issued nearly 89.7 million new shares to do it. By absorbing a transnational border crossing, they are really blurring the line between a traditional airport operator and a specialized border security enterprise, aren't they?
Yeah, and if we connect this to the bigger picture, the balance sheet impact of this merger is staggering. It reveals the true value of owning a logistical bottleneck.
Let's talk about those numbers, because they jumped off the page.
Right, so by consolidating CBX, JAP saw their cash and cash equivalents shoot up by 5.4 billion pesos. But the truly crazy number is the goodwill. It increased by 30.8 billion pesos.
Okay, let's break that down, because goodwill sounds like corporate PR jargon, but it has a very specific mechanical function in M&A, right?
It absolutely does.
Okay.
In accounting, goodwill basically represents the intangible value of an asset above its physical worth. So the Tijuana-San Diego border is one of the busiest land crossings on the planet.
Right.
That 30.8 billion peso figure, that represents the premium value of GAP controlling the only seamless private pipeline across that specific border. They're capturing high-margin toll revenue from international travelers who will gladly pay to save 3 hours of traffic.
And the margins they reported prove just how lucrative that toll booth is. They only included 2 months of consolidated CBX operations, May and June, in this report.
Yeah, just a tiny window.
And in that window, CBX contributed 291.1 million pesos to operating income and 315.8 million to EBITDA.
So that means the EBITDA margin for CBX was an astronomical 67.5%.
That is insane.
It's pure cash generation. And if you look at the 6-month pro forma view, it was nearly 70%. But beyond just the total...
Report saved them a 470.7 million peso provision. But what were they actually paying for before? What's the mechanism there?
So before the buyout, GAP was paying massive consulting and licensing fees to a third-party partner. This partner ran the proprietary software, the ticketing kiosks, basically all the complex data integration needed for cross-border customs clearance.
Ah, I see.
Yeah, so by taking 100% ownership, GAP brought all that IT and management infrastructure completely in-house. They fired the expensive outside consultants and instantly boosted their bottom line by nearly 500 million pesos.
That is incredibly shrewd. But, you know, expanding high-margin hubs like CBX doesn't make them immune to macroeconomic elements.
Not at all.
Because their heavy reliance on international travelers actually exposed a massive vulnerability this quarter. CBX connects to Tijuana, yet the Tijuana terminal itself was one of their weakest links.
Yeah, the passenger data there is actually really stark. Domestic passengers in Tijuana dropped 7.7%, and international passengers dropped 9.7%. Even the CBX users themselves dropped 9.3%, down to 935.9 thousand.
It feels like relying on international tourism is a lot like sailing. I mean, it's great when the macroeconomic winds are at your back, but you are entirely at the mercy of literal hurricanes and currency fluctuations.
And GAP got hit extremely hard by both of those uncontrollable variables this quarter.
Let's start with the literal hurricanes.
Right, so GAP operates 2 crucial airports in Jamaica, Montego Bay, and Kingston. During Q2, Hurricane Melissa hit the island, causing severe disruptions to flight schedules.
Which led to a 16.9% drop in passenger traffic across the Jamaican airports. Montego Bay alone saw a 21.6% drop.
Exactly. And then right after the physical hurricane, the financial hurricane hit them.
The currency translation. The Mexican peso appreciated 10.9% against the US dollar. Let's break down exactly why a strong home currency hurts them here.
Sure. It comes down to how they have to report their earnings. GAP is a Mexican company, so the official balance sheet is in pesos. But they earn a huge chunk of their revenue in US dollars, like tourists paying fees in Jamaica or travelers paying tolls at the CBX bridge in California.
Right. They collect dollars, but report in pesos.
Yes, and when the peso gets stronger, those U.S. dollars are suddenly worth fewer pesos when they get converted back for the accounting ledger.
So it's basically a phantom loss. The underlying business in Jamaica or California is operating normally, taking in the same amount of dollars, but the exchange rate acts like an invisible tax.
Exactly, and that translation effect was a massive drag. Revenues for the Jamaican airports decreased by 18.3% overall. They also had to log net foreign currency translation losses across the board.
And the bleeding wasn't just in Tijuana and Jamaica. Los Cabos saw a drop. Puerto Vallarta took a huge hit, with a 27.1% drop in international passengers.
Yeah, the traffic was falling, but the cost of keeping the lights on was skyrocketing. Their cost of services jumped 23.2% to 1.9 billion pesos.
What drove that massive spike in operational costs?
Multiple factors. Employee costs went up 20.5%, maintenance jumped 23.3%, and remember, they are now absorbing all the day-to-day operating expenses of CBX since they fully own it.
So it's a perfect storm. Dropping traffic, rising internal costs, and severe currency headwinds. Which really makes me wonder how they are insulating themselves. How do they stop the bleeding on the tarmac?
Their primary mitigation strategy relies heavily on aggressive route expansion. They are trying to actively stimulate demand by creating new connections. Even with all these headwinds, they partnered with major airlines to launch a flurry of new routes in June 2026.
Yeah, I'm looking at the list in the report. Volaris opened a ton of domestic routes out of Guadalajara, Tijuana, and Puerto Vallarta. They're flying to Querétaro, Reynosa, San Luis Potosi. They are essentially blanketing the domestic market to make up for the international drop-off.
And they're strategically targeting new international connections, too. Volaris added flights from Guadalajara to Salt Lake City and Detroit. Southwest started a daily route from Vegas to Los Cabos. And Wingo opened a route connecting Montego Bay to Medellin.
So diversifying the geographic risk.
Exactly. The logic is straightforward. If traditional leisure travel from California dips, you open routes to industrial hubs like Detroit to stimulate business travel crossovers. You ensure that if one demographic falters, another can pick up the slack.
But I mean, launching all those new routes, physically building the terminal infrastructure to support them, and absorbing mega mergers like the CBX bridge, that requires a massive war chest.
Oh, absolutely. Which brings us to arguably the most complex part of their financial engineering.
Yeah.
How they're structuring their debt. As of June 30th, GAP's total liabilities increased by almost 28 billion pesos compared to 2025.
28 billion. That is a massive jump.
And a huge chunk of that, about 18 billion pesos, comes directly from issuing new bond certificates alongside new bank loans.
Wait, hang on. I have to push back here. Calling a 28 billion peso increase in debt strategic optimization sounds a bit like corporate spin. Isn't it incredibly dangerous for an infrastructure company to leverage themselves this heavily, right, when their core passenger numbers are visibly shrinking?
It definitely looks alarming on the surface.
Yeah.
But to understand why they are raising all this capital, you have to look at their CapEx guidance for 2026.
Their capital expenditure.
Right. They're guiding for a massive 12.0 billion pesos in CapEx. They're actively building new terminals, expanding runways, and radically upgrading those high-margin commercial spaces we talked about earlier. That kind of physical expansion requires immediate, massive liquidity.
And they aren't just relying on bond debt to fund it either. In May 2026, they announced a process to establish an irrevocable trust to issue energy and infrastructure investment trust certificates. They call them CBFEs.
Yes, the CBFEs.
Their stated objective is to use these to subscribe a minority equity interest in their 12 Mexican airports. But okay, I need an five-shrine translation here. What exactly is a CBFE and why are they using it?
Sure. Think of a CBFE as a highly specialized financial instrument that lets a company raise cash by selling off a slice of its future profits. So they create a special trust that holds a minority financial stake in their Mexican airports.
Okay, I follow.
By selling these certificates to investors, GAP gets a massive influx of cash right now. And in return, the investors get a guaranteed slice of the future revenue generated by those specific airports.
So they are getting upfront funding without actually giving up the keys to the castle.
Precisely. The genius of the CBSE structure is that GAP raises billions in capital without giving up any voting control or operational dominance over the airports themselves. They remain entirely in charge of the ecosystem, but they spread out the financial risk.
But this raises that same question again. Why are they so confident they can pay back 18 billion in bonds and deliver returns to these trust investors when passenger traffic is down?
The answer to that is found in their revised 2026 growth guidance. It is arguably the boldest section of the entire report.
It really is the ultimate mic drop from their executive team. In this revised guidance, they are openly telling the market that they expect passenger traffic to be flat or even negative for the full year.
Right, they are officially guiding for -3% to 0% growth in passengers.
They are admitting right up front, we are going to serve fewer customers this year.
But, and this is the kicker, in that exact same table, despite acknowledging the drop in foot traffic, they guide total revenues to go UP by 7 to 10%.
Yeah.
And they guarantee EBITDA, their core cash profit, will grow by an impressive 10 to 12%. They are openly flaunting to the market that they have successfully decoupled their profitability from sheer passenger volume.
It brings us right back to that restaurant metaphor we started with. They are serving fewer meals, but because they own the Fast Pass bridge to get into the restaurant, and because they fired the third-party valet and took over the high-end cocktail lounge themselves, they're making 12% more profit.
GAP's second quarter of 2026 proves that in modern infrastructure, you don't necessarily need more customers to make more money. You just need to own the bottlenecks and relentlessly control the commercial ecosystem.
They navigated severe currency translation losses, a literal hurricane, a 23% spike in operating costs, and a near 6% drop in passengers, and still grew their bottom line.
It is a phenomenal pivot from a volume-based business to a value extraction business.
But it does leave us with a fascinating final thought to ponder as we watch this industry evolve.
Yeah, I mean, if a major airport operator can achieve record profitability while serving fewer passengers through premium fast-pass bridges, direct commercial ops, and complex financial restructuring, are airports slowly evolving away from being equitable public transit hubs?
It's a great question. Will the future of air travel mean the physical airport itself is essentially a luxury mall and a tolled logistical bottleneck?
Right. Where you, the passenger, are the product to be monetized, regardless of whether you ever actually board a plane.
Definitely something to think about the next time you pay for a premium lounge or buy a fast pass across a border. You aren't just a traveler anymore. You are a high-margin data point on an infrastructure balance sheet.
Well said.
And that wraps up our analysis for today. Make sure you hit follow so you don't miss our daily earnings coverage as we continue to break down the biggest reports of the quarter. Catch you next time.